Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And of course, we had Jerome in the house today, and the Fed gave us some great info today, guys. They're going to continue the purchase of treasuries and mortgage-backed securities. Like I advised, most likely they would not let us know this month. Remember, they meet again next month, and I have a feeling they'll announce a tapering next month because the next meeting is not going to be until September. Now, they're not going to wait until then. But Jerome Powell did admit in this video, yes, we've been having a lot of monetary support, and that's going to come to an end next year. Not only is it going to come to an end next year, but it's going to be cut in half. Actually, a little more than half. So, guys, we know that the Fed printed 20% of all money in existence in 2020. 2022, guys, get ready. He's already told you, get ready. This economy is going to be in shambles. Remember what the New World Order does. They create the problem. Wait for the reaction, run in with the solution. We know that solution is that programmable money, but first, the Americans have to feel that pain. Because remember, when it comes to the New World Order, it's all planned out. Y'all have a wonderful day.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us, maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchase data. Basically, there's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Elon, will depend on the pace of that progress and not on any calendar. Committee forecast, they're not a plan, and we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. If you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%. And the projections, they give some sense of how participants see the economy evolving in their most likely case. And honestly, the main message I would take away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals. So the other thing I'll say is rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff were very far from maximum employment, for example. It's a consideration for the future. So the near-term thing is really, the near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress. And transparent. And I can just tell you, we see real value in communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations. And we expect to be in that business until we reach substantial further progress, and then have a decision. Again, I have nothing further on time. It wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress, we think, but we're making progress.
So you can't say generally how far in advance you would signal.
Again, as we approach that goal, we'll provide as much clarity as we can. We think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned with it. It's doing. You have an unusual situation where the Treasury General account is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit, will that have any impact on, do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
It could have some impact. I think we'll have to see empirically, but it's designed to keep the federal funds rate within the range, and I do think it could have some effect on broader money market conditions below, as it relates to the very low rates and the downward pressures.
Okay, and do you think it will lower uptake on the reverse repo facility, or that's just not even really a focus of what the change was?
It's not. It's honestly, and the funny thing, you would think that it would, but we'll have to see. It's possible that would not be the case. Well, that's going to be an empirical question.
Okay, cool. Thank you.
And actually, people who work in commodity industries are very focused on that, because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I mean, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is we need to. Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience, and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because if they are, people will build new hotels. There's no reason for supply and demand to be out of whack in the hotel business over any period of time. So we think that'll happen. I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. That's it. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business, and we're very much attuned to the risks and watching the data carefully. In the meantime, I would say, we should, as I mentioned earlier, there's so much uncertainty around this. It's just a unique situation that we need to see how things evolve in coming months and see how that story holds up and act accordingly. Is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adaptive, flexible economy, more so than most. And by 2023, those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is a way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change of the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and you can't. It's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do. But I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had, and thinking that I have more confidence that we could see inflation above 2%. That it may not be as hard to do that as we thought, and that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things. The fiscal support in the forecasts is much less than it was this year. So, but you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022, and 2 to 2.3 in 2023. So you're right. You're seeing. I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year, coming on the back of a 7% growth year. That's a really good year. That's a year with a lot of momentum. That'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right? That's
still growing, and growing at a very healthy rate. Our estimate, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess answer your question a different way. Is there a risk that inflation will be higher than we think? Yes, as I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
You have some critics on Wall Street, and I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements. But if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announced a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we've written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was, will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors in a particular due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember it, prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which. But that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that. And that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And we have to balance the two goals: maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're gonna watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately. We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort. And China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.